All right, guys, let's get started. So thanks for joining. So a few housekeeping things. If you want to speak, I've given access to most people. You can unmute and speak. If you want to raise your hand, and then I'll allow you to do the same. Also, if you want to message, everyone in this chat, use the chat functionality. What you'll have to be careful about is make sure you select everyone and not just all panelists for everyone to see. So I'm just gonna add in chat. Yeah, so everyone should be able to kind of use chat. So people can hear me clearly, right? If someone wants to just unmute and confirm.
Yes, I can hear you.
Yes.
Oh, brilliant, brilliant. All right. Yeah, so today we're going to discuss futures and options. So apart from our normal disclaimers, please, these are leverage products. So you have to be extremely careful because as you might have seen with what happened with oil price, you can lose significantly more than the capital that you put in, which is kind of scary. Before I start, did anyone have a position in oil, the May contract that went to minus $36? Did anyone have any position in that?
Sorry, can you repeat the question, please?
No, I'm saying, did anyone have a position in oil when the oil price fell to minus $36?
I didn't, but my friend did.
Okay.
Okay. Sorry, could I ask a question here, Ruzba?
Yeah, go on.
Quick one. So the prices when they went into negative, those were the futures and not the current prices, current stock, isn't it?
Correct.
Yeah.
I mean, the challenge with oil is, it's difficult to have a spot price because most of the transactions happen in futures.
Okay.
Because you have to take delivery for oil, so it takes time and those kind of things.
Okay.
Yeah. Okay. All right. So yeah, let's move on. So for any newcomers, we are a big group now. We've got almost 6,500 members, which is amazing, and kind of growing every day. So this is what we're talking about, right? Like, if you are in the finance world, you couldn't have missed this, right? And a lot of people from our group, we ended up having a few discussions on WhatsApp. So this was like a crazy time. Any experiences people want to share about this on what happened on 20th of April? Anything that they saw, anything they saw with their friends, or any of that? So no one was really doing anything then. Okay, good. Yeah, I mean, for me, I looked at the price continuously, and I remember going to $3, and then we were thinking about, okay, maybe it'll be close to zero. You have times when securities trade something like 10 pence, 10 cents, 20 cents, but no one really expected that it would go in such a negative zone. Anyone knows why it went negative? And by the way, guys, I try and keep this interactive, otherwise people might fall asleep. So anyone can talk about why this went into negative territory.
I think maybe the major companies and refineries would have run out of space to stock oil, and perhaps because there was no demand, and the other companies were, they kept pumping, so people wanted to get rid of the stock, even if they had to pay people to get this stock. Number one. Number two, I think it's more cost effective to sell at a loss than to shut their plants, probably. I'm just didn't know too much in detail, but this is what I heard, and I read a little bit.
Yeah, fair points. Though, I mean, selling at a loss means, I think for a lot of producers might be, depending on which oil you look at, might be below $30, $50. But negative price is like you are paying someone to take delivery of oil, which is what we've never seen. Anyone else wants to add anything? Okay, so we will talk about this a little more later on. Obviously, this is the key topic today. And what we want to do today is instead of looking at futures and options from a theoretical point of view, we're trying to look at it from kind of immersion, trying to see based on what we see actually in the market. So hopefully it makes a little bit more sense for most people. So this is the long-term chart for oil, and it's phenomenal, right? I mean, if you look back for whatever years, 30 years, and you look at if you consider inflation and all of that, and then you see the price of oil going down to this extent was phenomenal. I mean, I had positions in oil in this particular contract, and I'll talk you through that. And one of the theses that I had was obviously, demand's going to recover over a period of time. And I think everyone believes that oil price will go up, back to maybe $50 or more. But the question was when. And basically the May contracts clearly meant that it's not happening in May or in April. By the way, do people understand that, for a May 2020 delivery contract, and everyone talks about May 2020, though the expiry date of the contract was 20th of April. So this is important to remember because we've seen people making a mistake saying, I'm buying May 2020 futures, which means the expiry date is going to be in May. But no, it's in April. Any thoughts on this before I move on, looking at the historical price of oil? Go on. Anyone wants to say anything?
So would you consider investing in oil anytime in the next 6 months?
That's
Probably
a good
not.
question. Yeah, let's hold on to that question. So we'll come to that a little bit later in the presentation. Yeah. Anyone else, anything on this before we move on? Okay. So yeah, so this was interesting. So this is about one broking platform. Anyone knows which broking platform this was, which basically had a massive issue when the oil price went negative? And does anyone know why?
Interactive brokers.
Yes, Interactive Brokers, yes. And do you know what happened there?
Not exactly, but I guess because they couldn't imagine that this was they thought that the negative oil price was out of the realm, so they didn't have I mean they didn't have enough coverage, so they have to take the losses because they didn't have a lot of they hadn't demanded a lot of coverage from their customers. Is that right?
Yeah, so I think a few things happened here from what we read in the media. One is that their system was not prepared to show negative prices. So imagine you're trading on a broker platform and you bought something, and then in real time, it's telling you what your portfolio is worth, but you cannot see negative prices. And the result of all this was that there's this guy who, I think he traded something like 80,000 US dollars worth of futures contract. Now, I don't know if 80,000 was the margin on the contract or the contract value. Okay, so I mean, this is a newbies class, so it's just kind of going into detail. Futures is a leverage product, right? So you could take exposure for, I don't know, £1 million, and you might be paying only, I don't know, 50,000 or less as margin. So when oil moves, 10% up, you make 10% on 1 million, even though your investment is only 50,000, which means you just made a 20% return. No, wait. Did I get my numbers wrong? No, sorry. You'll make 100,000 on 1 million as a 10% jump, and your investment was only 50,000. So you just made 200% of your money with that. So we don't know if it was the margin, so the $50,000 or the 1 million, which is what the exposure the trader had. And so this risk is beyond, what we consider. So at most times when we think about a security, at least the way I think about it is the max I can lose is, it goes to zero and I lose my capital. But in these scenarios, one, the oil price going negative. Second is the broking platforms were not ready for this. Also, I think it's the exchange that, so I don't know the real story, but some claim that the exchange gave only 5 days notice saying they will allow the oil price to go negative, which brokers claim wasn't enough time for them to kind of react. Any thoughts on this before we move on?
Yeah, I just wanted to say it'd be interesting how the legalities of this play out, because it kind of seems it's not really clear where the liability lies, because the markets didn't tell the brokers fast enough, and then the brokers obviously weren't ready, so the trader maybe can't carry all of the liability because the systems that he was relying on didn't give him the correct information.
Yeah, no, it's a valid point, and we'll talk about this. But I think the exchange had made it clear to the brokers, if the brokers wanted, they could have stopped the trading. So I think the responsibility now lies between the brokers and the trader, at least my non-legal view on this. But you're right, now who takes the hit? But I think most times we've seen that the brokerages would take a hit, because if they do not take a hit and this guy goes bankrupt, not many people are going to trade with this platform. So when we're talking about this, can anyone think of any other historical events that could have had a similar impact where even brokers struggled in recent times?
Yeah, there was a glitch some time ago in the system. I don't exactly recall what went wrong, but there was a glitch and something went into millions. The price crashed because of the glitch. I don't recall something.
I think you might be meaning the flash crash, or like the fat fingers when someone entered an extra zero into the system. Those kind of things were seen.
No, there was some
But anyway,
system glitch.
Yeah, system glitch, fair enough. And also there are issues with, in the US, Robinhood has had a few issues that people have complained about on social media. So, choosing the right broker platform or diversifying yourself is, I think quite important as well. So let's move on. So this is, I think, what Corey mentioned. So this is something very interesting that happened in India, but I think it happened in other markets as well. So, I mean, if you think about how the trading happens is the contract expired on 20th of April at 7 p.m. UK time. Okay. Now, what happens with this oil price is that people all over the world track this price. And so a lot of the other exchanges around the world, which if you think 7 p.m. UK time would be already shut in Asia. But then what happened was, because the price went negative, brokers and exchanges in these markets also reduced the price. Because when imagine you were like, okay, the expiry is done, you know what your profit and loss is, and the next day your broker sends you another bill because, hey, the price, globally has gone below zero. So in India, this was the case, and I'm sure in some other markets also, where brokers woke up next day and they had to go to courts saying the exchange cannot do this. But if the exchange does not do this, then maybe there are some contracts that the exchange might have taken for risk management perspective, which now puts them into trouble. So quite an interesting play, something that no one expected. Any thoughts on this? Also, because there are a lot of newbies, please let me know if I'm going too fast or if there's something that you want us to elaborate on. Please do that. Yeah, Anna, go on. You have a question or something?
Yeah, I just want to check. So if there is a negative price, which almost never happens with stocks, is it better to hold off from selling the stock and just waiting until it goes back up, or is it possible that the company will never recover?
So stock prices would typically not go negative. I mean, I'm just trying to think because we can't say never. Haven't
Yeah.
seen this, what has happened. So, but I can't think there's any logical reason that a stock price would go below zero, right? The difference here is that, and we will talk about this in further slides, is that we're talking about futures, okay? And futures have an expiry date. When you hold a stock, there is no expiry date. You can hold it forever, right? You can
So
hold it
can
for
I check what are
grandkids
the
or whatever.
examples of futures? Is it oil, gold, or?
Yes, so a slide is coming up, but yes. So you could have commodities. I mean, if you think about a futures contract, you can pretty much have with anything. It could be, I could say, Anna, tomorrow there will be no sun in London, right?
Let's hope
And if
not.
there is sun in London, you will pay me this much. So you can work out a futures contract in anything, literally. Obviously there are exchanges that regulate the contract and makes it easy. But if you think about, for example, if you saw The Big Short, right, where someone is having a contract with Goldman Sachs, now that could be a futures and options contract, but there is no exchange involved, so you could go directly to them. But we'll talk about what kind of futures you can have, but pretty much anything you can do. Yeah. Any other thoughts? Any other questions from anyone else?
Thank you.
No worries, Anna. Okay. So yeah, so a quick poll from people. So let's see. Yeah, you guys should see a quick poll just to understand where we stand with the audience. Can you guys see the poll? I haven't seen any response yet.
Yep.
Okay, it's coming through. It's coming through, yeah. All right, I think significant amount has polled. So, all right, I'm going to share the results. So what it looks like is most people are less than 1 year, which is, makes sense. This is a newbies session. And people have basic knowledge, which is good. And we have people, one person with advanced trading experience. So please chip in if you think, if I'm saying something wrong or if you want to add something. Okay, good. So the poll is fine. Let's move on. So this is my kind of position. So 80% of what I do in the financial markets is value investing. And then value and growth investing, a mixture. And then 20% of it is kind of trading and speculation. Because, value investing is kind of boring. And I know this, everyone should know this. So I need a little bit of excitement. So I trade. And this is the pot of money that I'm willing to lose if something, obviously I don't want to lose, but if something goes wrong. So just to kind of explain what happened, these are the closing dates of the transactions. So this is what I was thinking on 20th of April. So 20th of April was 11 days, which is, if you count the number of market days is even less. And I had sold it for $26, okay? Now imagine if I was still holding that position and it goes to minus 30, I would have lost something like 7,000-8,000 pounds on this, trade, which was supposed to be more for fun and excitement.
Sorry, Rosba, could you repeat the last point? I missed that. I didn't really understand. What price you bought and sold at?
Yeah, sure. So these are my trades, and as you can see, net, I made a loss, okay, on oil. So this is something you accept. Things go against you sometimes, which is fine. And my hypothesis for buying oil was, because as I said, inflation adjusted, oil has never been cheaper. And then I was hoping that Saudi Arabia and Russia and these guys will sort out that problem. So you see, these are the different levels that I bought oil at. This is the May contract. And this is the price that I sold at. Now, what I said was, if you look at my dates when I sold, these are all the dates when I sold. So this was in March, so a long time back, but this was April, okay? And so I was saying this is at $26 that I sold at April. Now, assume that it went to minus 36, and if I was still holding the position, I would have made a massive loss. something that I was not prepared to do. It was not, the level of risk that I wanted to take. Any thoughts on this?
Right.
Hi, Charlie, go on.
If you'd if you didn't have like £10,000 to lose, wouldn't there be like a margin call before that event happened?
Yeah, it's a fair point. Yeah. The thing with this though is I keep enough money in the account. But you're right. I think what would have happened is I would have capped in at about, £5,000. That's what I keep in the account. And then the broker would have raised a bill on me because I mean, even if you have a stop loss, I mean, they try and close the transaction at the next available price. So I might still have a little bit of loss, maybe £500 on top. But you're right. Yeah. Could have been capped off.
And what does this period mean? Is that the date the future expires?
Correct. So this is May 20 contract, which expires May 2020 contract, which expires on 20th of April.
I think here that I have helped Alex to get into, so I just sent him my link. So he's participating with my name, but it's just to know, because I tried to help him to join. Sorry.
That's fine. You sound the same anyway, so it's fine. It's okay. Yeah. Charlie, you wanted to say something?
Yeah, my question was just around what the period meant, but that was kind of answered. So that's when it expires. But the closing date's the day you made the sale.
Correct. Yes, the date that I closed my position. So obviously you can buy a futures contract, and because it's a financial market, you can close anytime before. And this is what happened to most traders, because, and we'll talk about this later, is some of us are in the market, as I said, for trading and speculation. So we don't want to actually take delivery of oil, right? I can't store oil anywhere, if I want to. And so I have to close before the expiry date. And if I don't, then I'm committed to take delivery of oil. And which is why people had to sell at whatever price available, because no one wanted to go and, receive this oil, essentially. Any other points?
Can you just remind me when the oil went negative again? What date exactly?
20th of April, 2020. I will never forget this date.
Okay, that was lucky then that you left before.
Yeah, and the reason I got out was not because I'm too smart or anything, but I was disappointed between the conversations that were held by OPEC, between Russia, Saudi Arabia, and others, about not trying to control the situation. And that doesn't mean that I'm in favor of having a cartel with all of these things, but it is how the market works. Yeah.
Can I check what is the source of information that you use? What are the best websites for this kind of information?
It's a marketing plug. I mean, obviously I run a site called City Falcon where we aggregate all the content. So obviously I use my platform first, and then I use my broker platforms to see, if they have anything additional that I should know.
Okay, but it wouldn't be the kind of information you could get from like just the regular news, like the Guardian or the Telegraph or Financial Times.
The problem with that is that it's all delayed news. And so if you really want what is happening now, for example, I was watching Bloomberg TV, and I think the live telecast was a little bit late. So it is still showing me $5, but on my trading platform, it's showing me like minus $5.
I see. Okay, thank you.
So it was crazy. Yeah, no worries. Yeah, Hamid, did you have a question?
No. Thank you. No, I'm fine. Thank you. I think as we go on, I understand what's going on.
Right, cool.
Like, is that just one futures contract? So it's just one contract. It's not a basket of contracts or anything.
Not in this case, but we'll talk about different contracts that you could get. But I was trading in only one. Okay, and the reason also this is that I know the fundamentals of commodities futures, but we haven't seen this happen. So I should have been more selective in what contract I buy, because I could have bought June contracts, for example, but the price would be much higher with this. Sorry, I'm just gonna, yeah. So let's move on. So I think Anna asked a question about where you can have futures contracts. So this is from this morning. So I want to explain how it works, right? So you see that Apple has a spot price, and I think it was something like $317. And then you have a June contract. Now with stocks, typically when it says June contract, it will typically end someday in June. I don't know if it's 20th of June or whatever date the exchange has kind of decided. I think it's the last, some weekday, I forgot whether it's the last or the second last Thursday of the month. If anyone knows, you can, chip in. But you see that, you can buy for June expiry 316 or December expiry 317. So when I am bullish on something personally, and I understand leverage, I've been trading for or investing for 20 years. What I would typically do is, instead of buying Apple stock, I would buy Apple December futures. Now, the benefit of this is that I can use a bit of leverage. So let's say in this particular case, and again, when I say all of this, I'm not trying to promote that you should be using leverage, but Apple was a bit of an exception why I used a lot of leverage. So we know that Apple has a lot of cash in the books, right? I don't know if it's 300 billion now or whatever. So what you could do is you could say, out of $317, what is the equivalent of Apple's cash in the books? And let's say it's $50. So I know that the stock price of Apple should not go below $50, like a very low chance that it will go below that. So I could work out based on that and say, okay, I will probably put 60% of the amount that I want to invest. So for example, let's say I wanted to invest 1,000 pounds in Apple through my broker. I could put, 600 pounds for a 1,000 pounds exposure. As per European Union limits, you can have up to 5 times leverage. You could be putting 200 pounds to get a 1,000 pounds exposure. I'll just pause for a moment for any questions or anything that people might have at this stage.
What happened?
Sorry, go ahead.
What happened if dividends, a big special dividend comes in? I mean, you won't catch it through contracts, through futures. Is that right?
It's adjusted. So the exchange would typically do this. And we have a slide on this, but just so I think dividend is straightforward. I think it's adjusted. It gets a bit complicated with options. I think futures is fairly fine, but things like stock splits and other things, you might have some issues in options. So this is one risk you're taking, but I think for futures, you don't have that risk. Not 100% certain, but I think generally it's done by the exchange. But did people understand the question? So what Dimitros asked was, so the Apple stock is trading at $320 now, for example, and Apple announced, I don't know, $30 dividend. Now, when they announce a $30 dividend, the stock price will correct to $290 because that dividend goes out of the price of the share. So it suddenly became 219, but you have bought futures for 317. So this is the price you have to pay in December, right? So the exchange will adjust it for you. So exchange will say you got $30 dividend. So they might put $30 dividend in your account. Or if your broker does it, so I use a broker that takes care of these things for me. The thing you have to be careful about is that when dividend is announced, and if you've not done your paperwork with your broker, in the US, they could retain some of it as, withholding taxes. So net dividend might not be very helpful. Does that answer the question, Dimitros?
Yes, you covered us. Thank you very much.
Cool. All right. Any other questions on this? Yeah,
yes. Ruspa, so let's say you bought shares of Apple December 20. This means you have to pay the remaining 800 in December to get the delivery.
So there is no delivery for, again, we'll talk about this for Apple, because it's not like oil. So there are 2 types of settlements in futures, which is also in the slide. One is delivery based, which is oil, and the other is cash based. So in your example, let's say if you hold this contract until December 2020, what
Yes.
will happen is on the day of the expiry, let's say the price is, I don't know, $350.
Yep.
Okay. They will adjust $350 minus 317, which is the price you bought it at, is your profit.
Okay. Okay, I see. And do you have the option of finishing this contract earlier if you change your
You
mind?
can sell it. It's a financial contract. Yes, you can sell it. So it's
Okay,
an
so let's say you
exchange.
bought it for 317 and the price goes up, and in a week's time you can sell it for 320, 325, 330, whatever the market price is after a week.
Exactly.
Okay.
Exactly. I mean, the one thing I would say is to be careful about is, if you're investing or trading in liquid stocks, then you're fine. But if you had, let's say, maybe a small cap stock, which is not very liquid, then the spread might be very high. So you just have to be careful on the spread you pay.
Okay. All right. So, and quick question, what is that? I knew it, but I forgot. It's after a long time I'm getting back into stock. So on the spot, what's the settlement time? Like how much time do you have to pay to get the delivery of a spot? Let's say if you don't buy future in Apple, you buy 10 shares of Apple and you want to have the delivery or the certificate, whatever, how it works. Is it T+1 or T+2?
So again, it depends on exchanges. It depends on your brokers.
Okay.
So it's totally dependent, but I think T+1, T+2 generally.
Okay.
If you use derivatives, then those are kind of instant.
Okay. All right. Cool. Thanks.
Anyways, more questions?
Bruce Bear.
Yeah, go on, Hamid.
Hi. Can you please explain to me? I'm confused about the sell and the buy prices because I keep thinking by looking at it, you're losing money, but I think I'm wrong. Can you explain how that works, please?
So you mean the difference between the buy and the sell?
Yes, please. Yeah, because I think you bought it at 318 and sell it at 316. You keep losing money, but I'm wrong.
So no. So this is not what I bought it and sold. This is what what my broker is showing me right now.
Okay. So what does that mean again, please?
So for example, let's say I want to buy a December 2020 contract.
Sure.
Okay, for Apple. Now the price I will pay is 320.02.
Correct.
Okay, that's the price. Now, if I were to sell it immediately, then I can sell it at a price of 317.70.
Okay.
Now, the difference between the two, the buy and the sell price, is a combination of one, the actual buy and sell in the exchange.
Okay.
And then sometimes brokers might have a fee involved, depending
Sure.
on what broker you use.
Sure.
Right. And so again, and tomorrow this numbers might be different. So tomorrow this might be sell at 320 and buy at 323.
Okay.
In
so
which
if you
case,
sell now, you will lose money, right?
yes, because that's basically, I mean, the way I would think about it is the commission you pay for the transaction.
Okay.
Yeah. So, but I mean, if you're holding it for, a longer time, you shouldn't be too worried about this.
Okay. Understood. Okay.
I'll give you another example that I have kind of learned through experience is you will find some companies are listed on multiple exchanges. So to give an example, I was trading Nokia, and Nokia is listed in the US and also in Finland.
Okay.
And Finland is denominated in euros. In the US, obviously, is in US dollars. And again, the prices are different. And then you might see that the spreads might be very different. So what I would typically do is I would compare these two and say, which is the place where my transaction cost is lower?
Sure.
Obviously, you're taking currency risk with all of these things. Even sitting in the UK, trading in the US, you're taking that risk. But at least try and keep my transaction cost low there.
Understood. Thank you.
Cool. No worries. More questions?
Could you get these for small caps, and how much larger would the spread be between the buy and the sell?
Yeah, it depends on the market data, right? It's like how many people are buying and selling. But yeah, typically you would see much higher spreads for small caps.
So I mean, like micro caps and that, would that even be available, or?
Depends on the liquidity again. With this, I mean, they might be available with really big spreads. I mean, it's like any other security, really. Like it's the demand and the supply. So yeah.
Thanks.
No worries. More questions? All right, let's move on. So this is now, so again, let's go back. Just notice this, right? So for Apple, you saw that the difference is not much, 316, 317. So in percentage, it's not a lot. So, I wouldn't be too worried. Now look at what happened with oil. So this was, screenshot I took on 20th of April, sometime in the afternoon. Okay, which is why it's still showing $10. Now this is the number that went to minus 36. Okay. And look at the difference between the two. It's not like 1%, 2%. Can anyone guess, what does this mean? What does the market imply by having such a huge difference in the prices?
That according to the delivery time, you have different prices. So actually, the market expects the price of oil to go up, already expects that, and that's why you see this difference. Actually, if you can store the oil, you can take the oil on May and pay the low price, and you can take advantage of it. But since you cannot store it, if you want to deliver it later, you can't catch the low price.
Yeah, exactly right. Anyone else wants to add anything, or if you didn't understand?
I didn't understand it.
So Amit, yeah. So what Dimitris is saying, this is May contract, okay, which means that the delivery will be happening in May, but the contract has to be settled on 20th of April. Now, what this is saying is, because we are in a kind of an unprecedented situation, recession, depression, whatever you want to call it, oil price is not likely to go up. Right now, what you could do is you could buy this now, because you can say, hey, I can buy this for $10, and see, I can see the July price is $28. That's an amazing jump, right? It's like 3x is pretty much the jump. But now if I do this on 20th of April, I have to take delivery of oil. Okay. So on 20th of April, and we'll talk about this, there are no tankers. Like, we need to store oil in tankers. And there is no way you can store oil right now, or at least in April. And so people are not, even if you wanted to buy, you can't really buy this. But if you want to buy in July, for which the delivery date will be the delivery date will be in July, but the contract expires in June, then the price is much higher. Does it make sense, Amit?
Yes, it does. Thank you very much indeed. Yeah, understood. Thank you.
Yeah, okay. Any other questions, anyone? This is kind of a very important point, so I'm going to pause here till everyone kind of understands this.
Like, where does it tell you the actual price, like the strike price? Like, because futures, like, you have an obligation to buy oil at a particular price, and then this is the price of the contract. But how do you know what the actual price is for the underlying future?
Yeah. And this is quite a good question. I think someone asked this earlier as well. So there isn't really a proper spot price for oil like we have for Apple. Now, the broker I use uses some mathematical formula about, like looking at different contract values and trying to kind of guess the spot price. But it's a commodity, right? And you have to take delivery. So there isn't a way that you can work this out. So unfortunately, you don't know. So it's pretty much demand and supply based on who wants to take delivery in April. On 20th April, that kind of decides the price. And this is why actually this is quite different from all the other futures that you look at.
So like, if I were to buy an oil future, wouldn't it say you have the obligation to buy oil at $20 per barrel at a certain date?
Which is what this is, right? This is the buy price. That's what this is. So you're saying you will buy oil at $10.56, which is, you can take delivery in May, and the expiry date is 20th of April. So this is the price.
Right, okay.
So there is always a month gap, is that right?
I think, yeah, the way these contracts are structured. But I was trying to figure out what's the longest period you can do an oil contract for. And again, it doesn't have to be through an exchange. It's also like, Saudi Arabia could talk to a country and say, okay, we've locked in the price for the next 9 years. So 9 years is what I heard, what I read actually, that countries can do.
Okay.
I mean, so I'm not in the UK right now, but have you guys did you see the oil price coming down, the petrol price?
Yes, it has. Yeah. At the moment, it varies from.
Hey, go on. Sorry, I think we lost him. Yeah, Wasim, go on.
Sorry, it depending where you
Sorry.
go in UK, is anywhere between £1.07 to £1.12 per litre.
Yeah, so you saw a drop. Now,
Yes,
I'll
yes.
give you an example. Yeah. So, and this is because I mean, UK is, I mean, now I live in Malta, so I miss UK a lot. I can see a few Maltese people on the call. Please don't get offended. I still love Malta. But when it comes to petrol price, we haven't seen any change. And this is because the oil companies here, the distributors, have negotiated a price, long-term price for oil. So they are not affected by the fluctuation. So we don't get the benefit of reduction in oil.
So we should find their stocks and buy their stock.
Say that again?
So if they are public companies, we should buy them. They have enormous gain.
Yeah, I mean, you could do that. Yes. Again, I mean, I don't understand the business well enough, but yeah, Dimitros, you're right. You should be buying these companies if you have long-term contracts. But sometimes you don't have this information clearly at what price they negotiated and all that. So yeah, Wasim, go on.
Yeah, so just 2 points quickly here. So when I look at the prices from May, June, and July, so one can predict that, okay, although it's down now, but the market expect the oil prices will go up, hence it's $22 and then $27 in July. Is that correct? This is how market is expecting the prices to behave, number one. Number two, let's say, just to exaggerate an example, let's say if I had or someone had place to store, so they could potentially buy
Sorry,
oil.
Wasim, we lost you there. Can you repeat? Sorry, we lost you.
Okay, where did you lose me?
The last bit, the last sentence.
Okay, so let's say if someone had the place to store oil potentially, does this also mean that they could buy and take delivery in May at $10? And at the same time, they also sell it because when it comes to July, they will have oil to deliver. Technically, can this happen?
Yeah, so Wasim, yeah, I think this is what Dimitros mentioned earlier. Exactly, that's what you can do. So you can take delivery for oil at $10.56, or when it went to negative, store it somewhere for 2 months, and at the same time sell a contract for July, which is at $28. So you already lock in your profit, right? Now the only thing you have to take care of is you will need a super tanker and you will need to store it for 2 months.
Okay.
We will talk about the cost of storage in one of these slides, and it's not cheap, because obviously if what happens is when people look at this, there are a lot of people with cash and the logistics to do this. So the arbitrage opportunity is usually quite low in these things.
Okay. All right.
Yeah.
Okay, great.
Yeah, Dimitros, go on.
There's another, like I don't think I quite understood previously, because like, okay, let's look at the first one. It's got a buy and sell, but that's for the future. Like, how do I know what the underlying price, like the underlying, because it will have a price, won't it? Like, won't just say you are obligated to buy oil at this price if you're long the future. So like, if every day that will change, the buy and sell for that future will change, but the actual contract won't change. So how do you find out exactly at what price you're obligated to buy oil at?
I mean, it's the price you commit at, right? So if I go and click the buy button now, you're committing to buy at $10.56. Irrespective if tomorrow is $12 or yesterday it was $9, you've committed to $10.56. Now, if it's $12 tomorrow, you can sell it. So it's the same contract. So net, what happens on 20th of April, the exchange will look at, okay, who is now holding open positions, who are still saying they're going to buy oil. And those are the people who take delivery. Does that make sense?
Yeah, okay. Yeah, it does. Thanks.
Yeah. I mean, I understand it's not a very easy market to play in, which is why please don't buy or sell yet. But it's okay. Any other questions before we move on?
Yeah, what happens if you can't take delivery?
Then you are basically in breach of contract.
And what does that
So,
mean?
I
What are
mean,
the
typically,
consequences?
consequences are typically if you're ready to take delivery, you probably have some kind of, license with the exchange, and maybe you have some kind of guarantee that you have given.
Oh, okay. Before.
It could be an escrow account. Yeah. I mean, the exchanges do their risk management, right?
Okay.
Yeah. And the whole benefit of having an exchange is that there is no counterparty risk or a low counterparty risk. So the only risk you are taking here is if the exchange goes bankrupt.
Okay.
Right? Because exchange has to manage someone, because someone is ready to sell oil and they have to give delivery. Now, if the buyer doesn't show up, the seller still wants to get paid.
Understood.
Yeah. And which is why, Hamid, and which is why people were so desperate that they were ready to sell at a negative price, because they did not want to be in that position of defaulting on the contract.
Understood. Yeah.
Cool. Any more questions? All right. So, so what we mentioned earlier, so you see the difference between Apple futures and oil futures contract is that one is cash settled. So there is no delivery that you have to do. It's a financial transaction. You buy for 10, you sell for 20, $10 is your profit. Simple, just like buying a stock. Oil futures is physically delivered, and this makes a massive difference. So when you're buying any kind of commodity futures, please look through how it's going to be settled. And this information should be with your broker or your exchange. Any thoughts on this? Do people clearly understand the difference now between the two?
Yes, sure.
Yeah. Go on, Kathleen. Hey, did we lose you? Okay. So now the other thing to keep in mind is with this market is, sorry, this is a little bit bright, the chart. But if you think about how it works is you have these big participants, and then you have market makers and brokers in between, and then you have traders, right? Now this market, the reason also it gets affected is that a futures contract on the exchange that we looked at is already kind of a contract which is looking at the future, which is, there's leverage involved. And then people have derivatives on top of that, right? So this could be the example I gave you with an exchange in India, which is relying on the price over here. Or, it could be some other, basically kind of building these different sets of, I wouldn't call it a pyramid, but the leverage involved in the system is pretty high. So if anything fails at one point, it brings everything down. So like contract for difference, CFDs, is kind of a derivative on top of the oil futures derivative. Does that make sense? Like it's like 2008, the crisis that happened where, the loans were kind of resold in different ways. And that's quite risky for the financial system.
So is this global or?
Yeah, I mean, generally, I think gambling is not legal in the US, so you typically don't have contracts for difference there, but in Europe it's legal. I think in a lot of markets in Asia, so yes. So given all of this, why does the exchange allow people to speculate on a contract? Why not just restrict it to the actual people who are looking to buy and sell oil? What is the reason for allowing traders? Any thoughts?
That would be narrowing the market, right?
Can you explain a little bit more, Hamid? What do you mean by narrowing the market?
Well, I mean, you've got institutions buying and selling. You've got market traders buying and selling. Why don't they allow individuals like me and yourself to buy? Because they can still make money between us.
No. So you're allowed to do it. So there are a lot of brokers that will allow you to do it. My question was the opposite. Why should you and I be allowed to trade, right? When it brings a lot of this volatility to the market, it brings, we're not really going to buy and sell oil, like actually. So why should we be involved?
I see. I don't know the answer. Sorry.
So Sen has, replied in chat. So he says for liquidity, which is correct. So, I mean, the reason to allow traders is that they kind of reduce the spread between buy and sell by actively buying and selling. So this helps, imagine you had someone who wants to sell oil, but there are no buyers, right? Because now when traders come in, they will look at that, they will look at arbitrage. So the thing you mentioned and thing Dimitrios mentioned, which is take delivery of oil now and then sell it next month. Now these are all good things, right? It kind of makes the market a little bit less imperfect, the pricing. So it's kind of helpful.
Okay.
So I think that's the reason that the traders and speculators are allowed in this market.
So just by looking at the futures, prices, you couldn't estimate the negative prices of oil, right?
Sorry, what's the question, Anna? I didn't understand.
I'm just wondering, when you're buying futures, like you showed with Apple and oil, there is no possibility of knowing beforehand that the oil price goes down. Is that right?
Yeah, I mean, it's like any security, right? How do you know what the stock will do tomorrow? Whether it'll go up or down? No one
True,
knows.
but I think for stock shares, it's you will have to just guess what's going to happen tomorrow and in 2 days. But if you're buying futures, you kind of need to guess, for example, what will happen in December. So it seems like less likely that you'll guess right, in my opinion.
I actually think the opposite personally. The reason is, so let me give you an example, right? So let's take an example of COVID-19. Now, if I were to ask you, Anna, tell me if the world over, will the lockdown be removed tomorrow? Okay, and at the same time, I ask you, will it be removed in December?
Oh, I see. Yeah, I suppose it's more likely in December. Okay, that's a good point.
So a longer term view, personally, for me, it's better. So for example, when I'm evaluating a stock, and if it's undervalued, I'm not thinking about tomorrow, but I'm thinking 5 years. What would happen with that stock? So I think, and I actually prefer futures contract in general. I mean, there are some other reasons. So I use spread betting, which is tax-free in the UK. So that helps me as well. Yeah, okay. Any other questions?
On your previous question, what I would like to mention is that what's fantastic for me is the wisdom of this system. So without anybody taking a decision to store oil, because there is the common belief that oil will be higher. So now we have plenty of oil, and the oil is cheap right now, and later on the prices will be very high, and that's a common belief. The system automatically works through contracts. So it tells you that you have to store, but there's no a politician or somebody who takes this decision, but it's the wisdom of the crowd. So I find the idea very appealing of people participating in that system. Also, sometimes you may have the madness of the crowd. So sometimes markets do not work well, but what I find, and that is related to your previous question, what I find as really interesting is the mechanism and and how this thing gives a solution.
Yeah, absolutely. I think, and we will talk about this a little bit in the future, but imagine let's say I'm an oil producer, right? And I look at these numbers. It's clear for me that I should not be pumping out more oil in May, but maybe wait for July, right? Or if I see a higher value in December, wait for that. So it can help you in a lot of different ways. Also the price, the people playing in this market, they have more sophisticated tools. They have more analysis than what you and I have. And maybe, I don't know, they know Boris Johnson, maybe they meet him for dinner, and maybe they have an understanding on when the lockdown will be opened. And all of that is kind of reflected in the price. Right, let's move on. So I want to talk about very quickly, just to move away from oil, that oil is not the only thing where this has happened. So historically, we've seen events where we have not been prepared to the extent that brokers have gone bankrupt. Now, we've discussed this a few times, but just to kind of remind this. So this is 2015. What happened was Swiss franc, which was pegged to the euro, suddenly ended. Okay. And what happened with the Swiss franc, I think appreciated 30% in a day. Now, any foreign exchange doesn't appreciate typically more than 2-3% in a day. Like an event like Brexit, maybe 5%, but 20%, 30% is crazy. And so one of the bigger brokers in the UK went bankrupt. Why would this happen again from what we've kind of discussed already? Why such an event is not taken care of? Any guesses? I mean, we've discussed a few of these things already. So one is leverage, right? So imagine you were trading Swiss franc, and I think back in 2015, you could take 1,000 times leverage. Okay, so a 30% move in a stock would be, like 3,000% move on your capital invested. And if it goes against you, then now the broker has to collect more money from the clients. And if the clients go bankrupt, the broker goes bankrupt. And this is what we've seen happening. Any questions? Does that make sense? Can anyone think of any other events that had such a big move that could have affected? Yeah, sorry, Amit, go on.
I was just saying, who were the customers, please, that make the broker go bankrupt?
These are the traders who are buying and selling things.
Traders,
yeah.
right?
Yeah.
What made them go bankrupt?
So is the leverage, right? So for example, as I said, what you could do is if you have 1,000 times leverage, let's say I want to take 100,000 pounds position in Swiss franc.
Sure.
Okay. Now, because it's 1,000 times leverage, I need to put only 100 pounds in my account.
Understood.
And I don't know if you've seen, but in London, it's quite common. You have these foreign exchange trading institutes, which kind of hires young kids saying you can use like a Fibonacci trading strategy, use leverage, and you can make a lot of money. So now when someone puts 100 pounds, that's what broker has. And suddenly from 100,000 pounds, let's say a 30% jump is now 30,000 pounds impact. So now this client might have to pay 29,900 pounds to the broker.
Sure.
Which no one expected.
Okay.
Any other questions, thoughts? All right, let's move on. Brexit, right? I mean, that was another event that, and obviously the event that triggers these things are not, when the event actually happens, but when the likelihood of the event happening. So if you look at kind of the movement in GBP compared to the dollar, that was quite a big jump, right? That happened. So I remember it was 1.5 pound against the dollar, and then before the Brexit vote, when it was likely that it could happen, or a small chance it could happen, banks were not giving you. So if you look at a futures contract, I think when I looked at it, it was 1.35. That's what the banks would allow me to hedge on. So banks are already considering a dip in the number. So these are kind of events that can that can make you a millionaire, or you could go bankrupt if you use a lot of leverage. Any thoughts on Brexit? Because everyone has thoughts on Brexit, right? Or no longer in 2020. Yeah, go on, Anna.
I think the news just was replaced from Brexit to COVID. So now it's just different worries that still shake the market quite a lot.
Exactly. Okay. All right, let's move on. So, sorry, this is a lot of text I usually don't like on the slides, but Ignore the rest of the part. I know it's difficult to ignore, but this is from the Europe regulation, and they had to reduce the limits, okay, back in 2019. So, but still, if you're trading on currency pairs, you could get 30 times leverage, or on cryptocurrencies 2 times, equities 5 times. And this kind of the leverage, you know, if things go against you, could be a serious issue. So just want to bring it out that it's kind of a regulated market. And there is some regulation, there is some leverage allowed, because if there is no leverage, then these brokers will be out of business. And any thoughts on this? Any thoughts on leverage in Europe?
Who provides the leverage, please?
I mean, it's the broker that's providing it, and obviously they do some kind of risk management strategies, which could be quite complicated, but there are some rules. So for example, look at this. Margin call out. So basically what they're saying is, if the client does not have enough money, okay, you need to close out the position of the client. So I know it's a bit complicated at this stage to understand. I'm trying to think of a simple example. Let's say you have, you know, 100 pounds in your account to take exposure worth 10,000 pounds.
Right.
Now, let's say the market moved 50 pounds against you. Okay. Now, which means that now your balance from 100 pounds has gone to 50 pounds. Okay. At this point, your broker might say, hey, your margin is running low. Either you deposit, you know, another 50 pounds, or we will sell your positions.
Sure.
So that's how kind of leverage is. But again, as I said, if it moves suddenly, then even the brokers are not aware.
Okay.
Any other questions on leverage? Okay. So does this chart make a little bit more sense now? Why did it go to minus whatever number was? Anyone who is still not clear after going through this? We can explain more. So it was just the May contract. Doesn't mean that, you know, oil in general is negative, but it's just on that day. And for the delivery in May, this price was at this level. So we talked about storage, right? So again, I'm not an expert on how these things cost, but the way the media portrays it, this is a big number. Oops. You have to pay $335,000 a day to store oil, right? Which is why it's better off to sell it at negative price than to incur this cost for a month or for 3 months if you wanted to store and sell. Does this make sense? Any questions?
Sorry, that's per whole tanker, or how that's the price counted? Because I know it's shifting, isn't it?
Yeah, it will be shifting. So I think it says ships able to carry 2 million barrels. That's what, so I guess you pay for.
300,000 per day for one ship.
Yeah, I guess. Yeah.
Okay.
Yeah. To store.
Sorry, Roosbeh. So usually these ships, obviously they don't store anything. They would just transfer it from one country to another, right? It's because there's no demand for it now. They have to obviously then store it, right?
Actually, Dimitros is a better person to answer this. Dimitros, you want to go ahead?
I really don't know, but what I have read is that it doesn't make sense to use them in other cases, unless I guess if there is a specific crisis in ships. But I think that this situation, the contango situation, the situation that people could take advantage of the difference of the contracts, and that's how it happened. And I think the same had happened again in 2008-9, and I think at that point there were more ships used. I don't know in other, but I guess it must be limited. That's my guess, but I don't know.
Can I ask you another question, please?
Yeah, go on.
Okay, so in this same scenario, if I bought 1 million barrels of oil at £10, for example, and then I had a contract with somebody, let's say in Turkey, and they said, I'll buy it from you at £30 per barrel in June 2020, am I still better off buying this and then I've got a fixed price that somebody's going to buy it from me. Is that a still a viable transaction or not?
Yeah, I mean, it is, right, theoretically. So what you said, but keep in mind, you'll have to do other things. So for example, insurance, right? Then you might have to move this oil to Turkey depending on how the delivery is. So it is kind of high risk.
Sure.
So, yeah.
Okay.
Why do you have to store it on a ship? Why can't you just put it in a massive warehouse?
I don't know. I don't think probably it's not safe to put it in a warehouse. I don't
because
know.
not many countries have a special storage equipment. The only biggest one is United States. And I heard that Donald Trump said, sorry for interrupting, that they're buying at very, very cheap price their national storage facility. They have millions and millions of barrels to store. That's what they do, but I don't know the quantities.
And how does delivery work? Do you actually give them an address?
I think so. I mean, I'm not an expert in this, but yes, there is some way of taking delivery because it's a contract to take delivery.
And do you have to pay for that delivery, or do they just?
Not sure. I mean, I can dig up something and send out a go on, Joe.
Yeah, I just had a question. If I am, say, a retail investor and I want to trade in a futures contract, does it not make sure, and assuming that I definitely don't want to have delivery on my hands, does it not make sense to make my trades like earlier in the trading period? So make sure that I'm not the last person to have to sell it to someone else before delivery. Am I right in saying that, if that makes sense?
Absolutely. But Joe, imagine this scenario, right? So let's say in my case, now I bought at 20, I bought at different levels, right? From 23 to $32. Now I look at the price at $10 on the day. Now the choice I have is I can square off and take a massive loss, or I hope that the price might recover. So I think what typically happens is more people think that it might recover. People think, hey, it's going to zero. In fact, interestingly, when this person who got a claim for $9 million from Interactive Brokers, it seems he bought oil at actually $3 per barrel. Okay. And very close to the expiry. So his view might have been it's $3. He will sell it, 1 minute before closing. Okay. And he's still fine. And maybe it becomes $5. But then it becomes -5, it becomes -10. But you're absolutely right. I mean, I would not trade now anything close to the expiry date with these contracts.
Okay, thank you. That's really helpful.
Yeah. More questions?
Can I check if the platform crashes and this person wants to sell it right 1 minute before closing? Who would be responsible for the losses? Would it still be the investor?
I would say typically it's the trader. But in some cases, you could file a suit against the trader, but it's going to be expensive. So I think in the US, we've seen cases like class action suits where people have sued the broker. I think there was something that people are talking about Robinhood, because on the day that I think the markets crashed 5-6% in March and then recovered 5-6% on another day, the Robinhood platform was down. So people could not get in and get out. But you're taking a massive risk, by waiting till the last minute. Maybe your internet connection breaks out or something else goes wrong.
Right. Okay. Thank you.
All right, let's move on. So, sorry, this slide is a bit blurry, but what is important here to kind of understand the value chain. So I think we talked about, okay, most of us agree that oil will go back to $50, let's say in July, August, and December. Now, how do we get exposure to that? Because there are limited contracts you can buy, and then you're taking this risk that maybe the lockdown continues, maybe there is a second wave of the virus that might come through. and then oil price doesn't go up. So you could look at different phases. So you can say, okay, who are the people who are exploring oil? Now for them, it's, if the price is not above a particular value, they're going to struggle to survive. Same with production. Now transportation has been quite lucky, right? Because now people want to store and transport. So these guys could actually do quite well and are doing very well. And then you have the refiners, again, depending on what contracts they've signed. If they have long-term contracts, maybe there is some benefit. And then marketing, like in Malta, for example, where they have negotiated contracts at a certain price, but now the price that you can buy it at, it's much lower. Does this generally make sense? The value chain and looking through where you want to play over here. And then if you decide that you want to play in transportation, then maybe you can identify some companies in this space. Thoughts, questions?
Sorry, could you tell me any big transportation companies who would be worth looking at investing stock, or it's too late now?
So I think Irmantas, based on what you mentioned, you probably know more about this space than I do. So I don't know any companies. I haven't gone into that detail.
Okay.
Yeah, but you're right. I mean, these things, you need to think about this, not when the price is already negative, right? But if you thought about this earlier, then yeah, you'd have made a lot of money.
Yeah. Okay, thank you.
Yeah. Any other questions? Any other thoughts? All right. But I mean, in general, anytime I look at commodities and other things, I kind of Google value chain. It's a very consulting concept, but it kind of helps you understand what you should be doing. Because I did see a lot of people pinging me on WhatsApp saying, should I buy BP? Should I buy Exxon? And I don't know the answer because I don't understand the space well enough. But value chain can help you do that. So I think Anna asked this question earlier, like what can you do futures trading in, right? So you could do stock, as we discussed, Apple. There is commodities. There's also index. Now I do a lot of S&P 500 index. So if I want to, for example, if I think the market is overvalued at this stage and there will be some recovery, I can short S&P 500, a future contract, and then I just sit on it and then see what happens on the expiry date. Does it make sense? Any thoughts?
Yes.
Any other contracts? Yeah, thanks, Anna. Any other contracts that people have tried in futures? Okay, seems to be very clear. So what is the kind of now looking at a little bit of the theoretical stuff, right? So what is a futures contract? It's an agreement, right? It's a contract. It's to buy something at a specific price on a future date. Right? It's as simple as that. And how do people use it? So to give an example, in my business, I run a startup we have about 35 employees now, and then I have a lot of technology cost. Now, my biggest cost is, most of my costs are denominated in dollars because that's what the costs are in technology. So what I could do now is, if I look at the pound dollar, because most of my money is in pounds, I could lock in a rate for the next 3 months, 4 months. And I say, okay, even if the pound goes down to, to parity to the dollar, if I have negotiated a contract, I stick to the price that I have in the contract. So this is kind of hedging. I'm hedging my position. Any other examples that people might have of why you would use futures contract?
Perhaps you want to factor in your cost of production, and you want to do your cost accounting. Let's say if you're producing something and you say, okay, this is how I'm going to calculate my P&L, and I want to buy so much of cement for next 6 months, and I want to agree a price today. So if the prices, whether they go up or down, I have done my costing and I've factored in my profit, if that makes sense.
Absolutely. So this is the bit about planning, right?
Yeah.
And also hedging. Absolutely. absolutely. And Sen says speculation. Yes, exactly. Cool. So I think that's the one of the slides I had. Yeah, so I kind of put this slide again, but I think we've spent enough time and people understood the difference. I will not go through this. So yeah, so 3 things that we can use futures for. Planning. So as I said, if I'm an oil producer or a transporter, like anyone, I can see the prices in the future and I can see, okay, and I can lock in prices if I want to. Hedging and then speculation trading. So this should be clear. Anything here? I can just pause for a little bit. All right, cool. So this is a bit complicated, but stay with me. I can try and explain to you. So imagine this is your payoff. So this is obviously 0. So as it goes higher, you make a lot more money. This goes lower, you're losing money in your payoff. Now K is the price at which you bought a futures contract. Okay. And so if the price remains here at maturity, right? So this is the spot price at the maturity. It's a point where you don't make any profit or you don't make any loss. Okay. So this is where, let's say I bought Apple at 320 futures and then it stays at 320 in the future. So there's no profit, no loss. Now, if the price goes higher, okay, and if the price goes here, this is the price on the expiry date, then my payoff is this, right? So I make a lot more money. If on the other hand, the price goes down, then I lose. So this is kind of a chart that a lot of sophisticated traders might use to figure out, and then you can probably attach probabilities to this and figure out what is your kind of, payoff. I know it's a bit complicated. Does it make any sense? Any questions? I can explain again if anyone wants.
Could you be kind enough to do it again? Yes, please.
Yeah, sure. Let's do it again. So Amit, did this make sense that K is the value at which you bought a futures contract?
Yes, I understood that bit. Yeah, thank you.
Yeah. And so the price at maturity, so this is a no profit, no loss zone.
Understood.
Okay? Yeah. So this is fine. Now, let's say the price could be a different price. So let's say this is 320. Now the price here is 350, 400, and this is $500.
Sure.
Now, when it's $500 compared to $320, I made $180. And that's this payoff. So over here, this would be 180.
Okay.
So this is the money I made through
right.
this. And same on the other side, on the negative side.
Understood. What does
I mean, you don't have to,
for?
yeah. I don't know, actually, to be honest.
Okay.
I think
okay.
I just picked it up from the website.
Okay.
Unless anyone else knows. Okay. And then the benefit of futures is, as I mentioned, you could also go short. So if you think something is overpriced, you could sell it now for a future price. And the graph is just the inverse to what we had. So I'm not going to spend time on this. I think it's pretty straightforward. So this is what we see on the oil price now. Now, can someone interpret this for me? So this is what I got screenshot just before this call. What is this saying? Any guesses? Come on, guys. I know it's a bit late.
Market is expecting
to buy or sell and go on.
No, Demetrius, go on. You started. Go on. Okay.
Does that mean they guarantee you that they're going to buy?
Okay. So what you can do, you can lock this price, and you can deliver or delivery of the oil at this price. You can lock this price. If you're a producer, you can lock that price. So whatever the price will be on August, you have locked this price.
Yeah, that's fine. Okay, that's fine. Okay, other people. Wasim, you wanted to say something?
So you see the prices going up from June, July to August. So market expect the things will ease off, and there will be some activity and demand. Hence, the prices will go up. In the oil prices may go up. This is how market is predicting.
But we know that, right, Wasim? We knew that oil prices was going up on the previous thing as well.
Yeah, I kind of forgot the point I was trying to make. Sorry.
No worries, no worries. Who else? Sorry, Hamid, you wanted to say something? Or Irmantas, go on.
No, I was just saying that's the fixed price. They're basically guaranteeing you they're going to pay that sort of money, right?
Yeah, I mean, that's with any future contract. If you buy it now, that's that guarantee remains. But
Yes.
that's for any case. Yeah.
Okay.
Irmantas?
No, it's just very thin, how to say, difference between buy and sell. It's very small on any of them.
That again depends on probably when I took the screenshot and what time of the day. I wouldn't worry too much about it. Okay, let me show you guys the graph, the thing again to compare, right? So look at this. Okay. Absorb this.
So the price is very different. Like the price difference is huge on there.
Exactly.
Because it's here you can get for $10 roughly. Here is 20 and here is 27. It's nearly 30. And down there it's already prices going like in the, how to say, very stable swing. It doesn't have huge gaps between the price.
Exactly. That's the point. So if you think about, guys, and this is my interpretation, right? When you look at this from April, right? What the market was saying was there was a lot of uncertainty in April. There's lockdown and all that. And then they said the uncertainty might still remain in May, okay, which is why the price goes up. And there'll be more certainty in July. And you see the big gap, $5 gap here. Okay. So $5 gap here is like 20-25% difference, which is quite big. But now look at this difference. Is significantly reduced, right? So what the market is saying now is that from a demand perspective, they think the demand now and August might not be too different. And obviously it's much more positive than the $10 then.
Just my short question would be, can these price changes, they can change over the time? Let's say up to the end of May, it might change. Absolutely. Theoretically, where I see is if the countries will, let's say not open, but if planes won't get the deals that they can fly, which I think is one of the main consumers of the oil. So these prices may go down. Just theoretically.
Yeah. So, I mean, Irmantas, think about it this way, right? Before all of this started, oil was at about $60.
Okay.
Okay. So even when you look at 25, 26 is not a massively different things.
No.
Yeah. So, 25, 26 is still quite low compared to $60, but it's showing stability. So we have a question from John in Q&A. What are the blue triangles for? I just think it's for maybe the last traded price has gone up, but I wouldn't really look at it. It shouldn't really matter. So I mean, it shows that kind of market believes that we have a little bit more certainty now in May. Okay. And you may agree, you may disagree. Just to kind of go back to, let's look back at this one chart. Yeah. So if you see what happened on 20th of April, before, like in the morning, it was traded at whatever. I mean, this is the slightly different crude. This is the American crude. So it was at $15. So most of the action happened on the last day of the contract on 20th of April. So even if it shows right now, the price to be $25, it might again go down. Yeah, Dimitros, go on.
Can this mean that maybe the very low prices were because of speculation? So people with not a lot of crew, people that they were buying USO, so they were tending to buy short-term contracts, and they were renewing it without their knowledge. So in that way, actually, they were buying contracts, and they were, and then because they had to sell them, they were pushing the price. So maybe those prices that we were seeing in contracts were not close to a real price. So it was because of speculation, and maybe now it means that this is over. I don't know if it's because people think that prospects have changed, or we believe that maybe those low prices were like invalid. They were caused by craziness.
Absolutely. So I mean, you're talking about a lot of trading issues, unexpected. People were not prepared, right? People had not seen this kind of dip. So maybe, or let's hope this month we will not see that action. Yeah, Irmantas, you wanted to say something?
Something. I'm sorry for interrupting you.
No.
Something that has happened is that because USO had a lot of problems, it used to be an ETF that is renewing the short-term contract. So it was just month forward contract, and they were renewing the contract. And because they were at risk of losing if negative prices came again, and because they changed their so now they are invested in forward months. So they have split their contracts in 4 or 5 months. So they have gone away of their initial strategy. So they don't follow the spot price of oil. So I don't know if that plays.
Okay, I think we lost Dimitros. But yeah, so you're talking about the USO ETF, which a lot of people bought, assuming that it will reflect the increase in prices. And this fund was affected so much that they had to change their strategy. But there is pretty much, if you look at the instruments available, it's very difficult to find an instrument that you can buy, which can basically allow you to say, okay, I want to benefit from oil being at, I don't know, $50, $60 in December this year. There is literally nothing that you can get at this stage.
Sorry,
I mean, you could buy. Sorry, go on.
Could I ask a question?
Yeah, sure.
When we see this negative contract, which dropped minus 30, I think, dollars per barrel, right? Or negative.
So
in theory, if I would be a very wealthy country, or somebody who has a huge funds and place where to put oil, does that mean that I could buy off all them contracts and they would pay me the money that I will take your oil?
Yeah, absolutely. Theoretically, you can. The thing though is that these contracts, the price might have moved on low volumes. Okay, so there were the fact that there were no buyers or less buyers and too many sellers might have just pushed the price down, which is what kind of Dimitros was also saying. It might be a technical issue rather than a fundamental, issue with oil. But you're absolutely right.
Yeah, let's say somebody just sold 10,000 barrels, which is nothing, but it shows as negative.
Exactly.
And it shows everybody that it goes to negative side. Okay. Yep.
Exactly.
Understand. Thank
exactly.
you.
And this is why, if you look at the way any market works, is people trade till the last second when the market closes, but the market then readjusts the price every day to reflect what is a more realistic price rather than the last traded price. Because someone just trades one share of Apple, for example, theoretically, let's say at $280, but the stock is at 320, doesn't mean the stock should close at 280. It's literally, there was just one share. So there are mechanisms built in the markets to take care of those things. But in general, a lot of my guess is a lot of countries like China, for example, they were in the news. They would have bought a lot of oil in these stages and probably stored it. Again, with the US as well, as you mentioned, with the storage capacity. Right. So the cinema will start again on 18th of May. So this is when the contract expires. So guys, free up your time. Okay, see how the oil price moves. Get in front of any live platform, maybe a broker platform, to see how the prices move. If you're looking for news, anything, obviously use City Falcon. So we track everything in real time. It's like usually in milliseconds. So there'll be a lot of action. And who knows, it might go into negative, or it might go at $10, or it might just stay stable. Yeah, actually I should have done a poll on the price, but maybe next time. So guys, I know it's a bit late, but I just want to make sure people understand the concepts really well. So Wasim, you asked the question about trading platforms. So I would recommend not trading in futures yet, and I'll tell you why. It's super risky. And I wouldn't personally recommend anyone at this stage, but you can Google it if you really want to. There are lots of platforms. Just be careful on what they offer, what the commission rates are. Some brokers, for example, are not happy when you withdraw the money. So they might have some fine print, so just be careful on those things. But let's do this simple exercise, and I'm going to do a poll for you guys to answer. So imagine we're looking at Apple. The spot price today is $320. Okay. And today is obviously 12th of May. I'm buying 30th June futures contract for $325. Okay. Now, I want to figure out what will be my profit or loss on 30th of June. So the data points I have for you is the spot price on 30th of June is $400, or on 30th of June, you can buy 31st July futures for $420. Okay, so I'm going to try and start this. So you guys need to work out and give me an answer on what the answer is. So all the values are negative values means a loss. All the positive values means a profit. This is kind of becomes like who wants to be a millionaire kind of question. And we're asking the crowd. Only 6 answers. Come on, guys. Okay, I'm going to stop the poll. Very few answers. Anyone wants to talk through? So the winning answer is $75. But there is also $75 loss, so different value. Anyone wants to give their own answer? And no one's judging you, don't worry. Everyone's here to learn. So anyone wants to talk through this?
Yeah, I can. Sorry, I probably misunderstood a little bit. If you're buying a contract, that means your price is fixed. And yes, on the day of 30th of June, if the price is 400, no matter what, you must sell for 325. Isn't that the thing? That's the point of it.
No, you're buying. You're buying. So what you're saying is, I am buying Apple at $325 on 30th of June. And today you might only give a small margin, which your broker wants.
Sorry. So then, yeah, sorry, I misunderstood the concept.
That's
I
fine.
thought that you buying like for 325 and expecting maybe it will fall, the price will fall, but you will still get your, 325. But if price will rise, obviously you're gonna be on the loser side because the price will be 400. So you're gonna be in negative. Instead of making 75 plus, you're gonna be losing. So that's why I mark it minus 75.
That's fine. That's fine. But what would your answer be now?
Now you would be making 75.
Okay. All right. Any other answers?
Ruzbe, sorry, I don't understand this. Sorry, my apologies.
No, go on. So what answer did you pick?
£20.
How did you work that out?
Well, because it says spot price today is 320, and then you bought the contract on the 30th of June for £325. What is the difference of the two? I mean, did you buy it on the day or you bought it later on?
No, so the difference is, as I showed you earlier, is different contracts have different prices.
Right.
And we'll talk about why there's a difference between today and 30th June,
Okay.
because there's more time.
Okay,
right?
okay. And then what is the next one then? Because if you bought it on the 30th of June for $325, and then on the 30th of June, you paid $400, what does that mean?
Okay, maybe next time I'll put in, I think it might be easier if I put on what date we bought. So these two are what we're doing now, okay, today, right now.
Sure.
So we're buying, and this is actually on 30th June. So imagine now today is 30th June, what will happen? So exchange will look at the price and exchange will say, okay, now the price of Apple is $400.
Okay, understood. Yeah. Understand that now. Yeah.
Okay.
Yeah, understood.
Any other answers? We have answers for $95. 3 people. How did you get $95?
So from my end, I guess that when you buy on the 30th of June, you buy for 325, then you could sell on the 30th of June for 400, but then you decide to sell, so you have $75 difference, and then you immediately go into buying for 420. So you might have 20 additional dollars if you sell on the 31st of July. But I think I read the question wrong, because I thought I read that it would be the 31st of July. So
no worries.
yeah, now,
so you're assuming,
now I think it's
you're
75.
assuming they're bigger. Yeah. I mean, the challenge that, yes, sorry, go on.
Sorry, can I just check that if you buy futures, then the price 320 is quoted by the platform, right? You cannot guess that this is going to be the price. You just agree that this might
It's
be
all
the price.
it's all demand and supply, right? So it's the price. All of these contracts is what the market gives you.
Okay.
If you're buying,
so you
who's
either
selling.
just agree with it or you don't play futures.
I mean, if you don't agree with it, then that means that the price might change if a lot of people don't agree, and that's why the price moves up and down, right? And it moves up and down every few seconds. It's not even days. But good point on but interesting that you thought about the futures. But if you think about, if you want to, and this is something called roll forward, okay? So wherein you said, okay, I'm buying this contract now. On 30th of June, it gives me $400, but maybe I believe this could actually go to $500. In which case I buy on 30th June, the contract for 31st July. Okay. Some brokers allow you to do this automatically. It's called auto rollover of contracts. So you could continuously auto rollover for the next 5 years if you want to. I did that with Apple. So I made some money, luckily, when, Apple price was down 50% in the recession. And I just held it for 2 years. And it was auto rollover of future contracts that the broker did. I didn't have to worry about it. Okay. But the profit on 30th June is still $75. Right? Because this is the price I bought it at. This is the actual price of the stock. So do people agree, $75? Does this example help you guys a little bit? Yeah?
Yes.
Yeah, I think it does. Thank you.
Okay. Let's do another example. Okay, let me start another poll. Right. So very similar, that I bought 30th June contract for 325. And then I sold a contract, okay, on 1st of June for $300. But then on the spot price on 30th June was actually $400. Okay. So now what is my profit or loss? Let me open the poll.
Was the profit on the 31st of July or the June one?
It's a good question. I will not answer that yet. I'll let you think about it.
Okay.
I can see only one answer. Okay, 3.
Because it's a difficult question.
But at least it help you kind of, understand the concepts a little bit more.
Exactly.
Okay, 10 people have answered. All right, we can stop here. So we got 2 answers, so that makes it interesting. Now, can someone explain the $25 first, the loss of $25? How did you get that?
Since we sell the contract before the expiry, we don't own anything on 30th of June. So it's just a matter of price we buy the contract, a matter of the price that we sell the contract.
Got it. So you're saying you bought at 325 and you sold at 300, so that's the 25. Okay. Who explained to me $100? Someone, one of the 3 people. Or are you just being optimistic and taking the lowest prices buy and highest prices sell? All right, no volunteers, but the answer is 25. Yeah, you make a loss because on 1st of June you exited the transaction. You sold what you have. So anything that happens out after 1st of June doesn't really affect you. Right? So these are the 2 values, and that's it. Your trade is over. Does that make sense to everyone?
Yes.
Yeah. All right. So now, and I'm doing it reverse from university. So instead of showing you the formula first, I'm taking it at the end. So what is the futures price, right? So futures price is kind of what is the spot price today. So in this example, it was 320 for Apple. And then you add the interest rate, right? And then you say how long that interest rate is for. So it's just basically compounded interest rate formula, essentially. So what it's saying is, it's fine for you to do a contract on 30th June, okay, wherein you will buy Apple shares. But between now and 30th June, there are 45 days. And now these 45 days, I could have earned interest on my money, okay? But instead, I'm waiting for you. So you will have to pay me the interest for this period, right? So that's kind of the theoretical definition of how a futures value is calculated. Of course, in reality, all of this doesn't matter so much because, it's the demand and supply that comes in. Does this make sense? Theoretical definition?
Yes.
Ruspe, in your experience, what's like an implied interest rate that they actually have, a yearly annualized interest?
I wouldn't know. I mean, so risk-free interest rate right now is almost close to 0, right?
I mean, what the future imply? I mean, if generally speaking, you have stocks trading, of course, it depends on the prospects of the stocks, I guess. So it's difficult to answer. But on average, do we have any clue of what is it per year? I mean, do we see that the futures are 5% more expensive than the spot price? They're 10%. As you said, is a market function. But if you had a view on that.
I don't know the numbers, but I think as you would expect in these scenarios, it's quite complicated because not everyone, but if you look at the way US markets are trading, it's expecting a V-shaped recovery, right? So S&P 500 and Dow Jones are saying, okay, as and when we go back after lockdown, things will be back to normal. In which case, the futures premium is quite high, right? Because if you were to buy something that with a delivery in December, it's going to be much more expensive, like in oil, for example. But images, I don't have actual numbers, on this. Yeah. Any other thoughts?
Rusbeth, is it,
Yeah.
so is this used to calculate basically the strike prices for the futures, right?
It's the futures price. So it's the price you it's the price you commit today, even though you're paying in the future.
Yeah. Yeah.
Yeah.
Okay.
I mean, that formula doesn't really make sense to me if you like looking at it from the perspective of an index or something like that, because you wouldn't expect the index to go up by just the risk-free rate. You would expect it to go up by like the historical average.
Yeah, so I think, so you're right. So you can take that view, in which case, you should be buying futures. But I think what it's saying is the risk-free interest rate kind of is trying to mirror the inflation. So, and this is my kind of interpretation of this. The stock values over a period of time go up because there is inflation. So the revenue goes up by at least 3%, 4% a year. And so the prices will go up. So if you're buying a futures contract for next year, then you need to be compensated for this inflation, which is kind of through the risk-free interest rate. Does that make any sense?
Bruce, but may I ask something? If you see that, let's say there is a lot of difference, if you see it as a lender, so you say instead of putting my money at the I will buy the stock and I will sell the future. So if there is a 10% interest, I will act as a lender if I see in a stock a difference. Can that make sense?
Absolutely. And this is where the arbitrage comes in, right? So this is where hedge funds and others will look at it. So people who are playing with interest rates and these kind of things, and stock yields and bond yields would absolutely do this. So yeah, and you could also even have quant funds who can be doing this, because this is what you said was quite quantitative, right? Doesn't require any judgment. Does that make sense? All right.
Yeah, thanks.
Cool. Let's move on, guys. So, we've discussed this already, but just a reminder, you see again the different prices, and this could be because of the delay by a month or a quarter over here, actually, right? So that you have to pay a little bit of premium for that that you buy. So we discussed this earlier, but be careful. If companies like Apple typically would announce dividends, maybe not now. And so the price keep changes. If you see any splits or bonus, futures prices might be affected. Typically, most of these things need to be adjusted by the exchange, or your broker. But just keep a check. If there's a technical glitch or something, you might not get the money. So I'm conscious of time, so that's why I'm running through. So what is the difference, right? So I could buy stocks in a spot and the futures. I would recommend buy on spot for now until you understand how futures work. So typically there is no leverage. There could be in some situations if you use some tools, but in futures you could get 5 to 30 times leverage, 5 times for stocks and 30 times for non-stocks. Now this is interesting, right? So a stock you can buy one share, right? Now you can even buy a fraction of a share with some of the tools that are available. But for futures, there is a minimum contract size. So when I buy with my broker, like they will force me to say, okay, minimum 1,000 pounds exposure. So I can't be putting 100 pounds in. So keep in mind that the contract sizes are big. You don't have any shareholder benefits. You can't go to Warren Buffett's, meetings or anything with futures. It's just a derivative of the underlying. With stocks, there is no expiration date. So you can hold it for 5 years. With futures, there is. So what you can do is, as I explained, you can roll forward. So you can hold it for 5 years, but each roll forward will cost you money because there will be a transaction cost involved. So keep that in mind with your calculations. Most brokers will give you stocks, but very few will give you futures. With stocks, it's very difficult to have short positions. With futures, you can. So these are kind of the main differences. Any questions, anything at this stage?
What are the famous platforms for futures?
So I use a lot of spread betting and CFD platforms. Okay. If you go to, I'll try and find it, but if you go to City Falcon blog, I had done research on a few brokers, and you can see which ones. I avoid recommending brokers personally because like most brokers do something dodgy generally, which scares me. One broker I find very reliable and historically is IG. Okay. And we don't get any affiliate or anything with IG for City Falcon. So to be clear, but IG can be a little bit expensive compared to the other platforms. But I find it the most reliable one.
Okay, thank you.
I just came across a very useful website called brokerchooser.com. I will put it in the chat. And they give a comprehensive overview and a comparison of various brokers basically across the world. And they compare what the services they give and the prices you need to pay, and whether they recommend them for beginners or more advanced traders.
Yeah, share it out with the group so people can.
Okay,
thank you.
Yeah,
just one second.
Cool. Yeah, cool. All right, let's move on. So, I mean, I kind of guess that we won't have enough time for options. So we could do it in the next session. And also it might be quite complicated, but I just wanted to quickly share what are the differences. So as we learned in futures, you could make profit and you could make a loss depending on how the situation is. So it's called a right and an obligation. While options, what happens is there is no obligation. So I can buy an option. Okay, so I can say I want to buy an option to, and I'm simplifying things, to take delivery for oil for $26, okay, next month. But then the actual price is $10. So I can refuse to take delivery. Okay, that's how an options contract would work. So I don't have to worry. But obviously for this benefit, you have to pay something like a premium. And this is like your insurance that you're paying on this. And some people like to play with contracts with options because it can give you unlimited profit, but there is limited loss. Okay, while in our futures, there's unlimited profit and loss. Okay. Now, if you look at this, most people will jump to the conclusion that we should be using only options and not futures, right? Is there a reason why you should not be using options? Any idea? Go on.
I'm not actually sure what options are, so I'll need to read up on that.
Okay, don't worry. So we'll connect. We'll discuss this next time. Don't worry in detail.
I think it's all depends on what's the premium you're paying.
Exactly.
For limited loss, because it might be you may lose all your profit, maybe for premiums only.
Exactly. So it all depends on, it's like insurance. Like in the UK, if you're taking car insurance, you might ask yourself, do I really need insurance, or am I better off, paying off when the damage happens to my car? And it's kind of a similar discussion here that you think of. But anyway, we'll go through that in detail. Now, guys, I know it's late, but quickly show you some new features that we've launched on City Falcon, which you're welcome to see, or if you, I won't be offended if you decide to leave at this point. Well, it'll take 3-4 minutes, just quickly explain. So this is our platform where, you can track 300,000 topics if you want to track oil. And we bring in all the content from Twitter, from news publications. We are adding premium publications where, there is no paywall. We are adding things like sentiment analysis, filings. So the idea is that, I've been a value investor for 20 years, and I want to build all the tools that other value investors need and bring in automation, bring in notifications, bring in artificial intelligence to make your life easier. So one of the features we've just launched is, imagine, there is one news which is cluttered with, 20 people, 20 publications saying the same news. So using machine learning, and this is already done by Google News, right? It's done by Google News for years, but it's not very common in the financial space. So if you go to Yahoo Finance or Google Finance, you don't see this. But we are now grouping all the stories. So what you can do is you can get a feed now, which is unique stories instead of having stories repeating all the time. So we will launch this in the next 10 days. It will be on the platform, and it's free to start with, and then there are premium subscriptions. So this is the first feature. We call it kind of similar stories. The second thing is we realize that we have more than 5,000 publications on our platform, and people want to choose which ones they want and which ones they want to block. And this you can't even do on Google unless I've missed any settings. So what we're doing, and this is kind of ambitious because we have to do this, like all of this needs to happen in milliseconds, which is always a challenge. But what you can do is you can now select your favorite publications. So if I'm tracking oil, I'm not getting 5,000 publications, but you can choose up to 100. And the only reason we have a 100 limit is just for performance purposes. If you increase this, it becomes, slower. So this is a feature, again, we will launch in our next mobile app. Another feature we're launching is you could now search through our full archive. So if you want to do historical research on a stock, if you want to see what happened to Tesla when they announced results, you have access to all of that. So this is, so you can really customize the platform as per your needs. And the last thing is with all the creative people and design people, we couldn't figure out what is the best feed format that a user likes. And so now we are allowing you to choose. So you could choose whether you want a tile format or a rows, you want to see images, description, like you customize and you decide how you want to use it. So these are some of the new features. If you want to try it out, it's cityfalcon.com. In case if you're looking to access the old webinars, also this particular webinar, one, you will get an email tomorrow, or you can also download all of this from cityfalcon.com/meetup. And if you're interested on any of the opportunities that we've discussed before, starting from 2015, again, there is a link on this site, cityfalcon.meetup, which will take you to this Google Sheet where you can track all of this. That's it, really. Thank you very much. Any questions, any suggestions from anyone before we close?
Roosevelt, can you tell me how often do we have these sort of meetings, please?
So we will try and do it every 2 to 3 weeks, depending on demand, depending on what happens in the market.
Okay. And my last question is, I've never ever traded in my entire life. Do you think trading would be like gambling?
Yes, avoid trading, start investing. And we will do a session on understanding the difference, but own things that you're going to buy, keep for the long term.
Okay.
Rather than trade, get in, get out. Trading is, it's speculation, gambling.
Okay.
And also if you're just starting off, there are several platforms that allow you to work with virtual currency. So instead of actually putting pounds and risking that, you can just, play with virtual currency and you don't lose anything.
So like a dummy.
Yeah, exactly. And then once you have the confidence a year later, 2 years later, then you can start using real money.
Understood. Okay.
More questions or anything else?
Yeah, Ruspa, in the beginning, you mentioned something about being tax efficient or tax-free trading or something. I didn't catch up. So what are the taxes like, and how can one be more tax efficient? Like it depends on the broker, the platform, or which country you're trading in.
Yeah, I mean, all of those things. In the UK, gambling is tax-free. So any product, any broker product that you use, which is considered gambling, you do not pay any tax. The exclusion is if you're a professional trader, which I don't think any of us are.
Okay.
So that will be tax-free. Now, the other thing you could look at is obviously different jurisdictions. So when I'm sitting in Malta now, I'm a Malta resident. When I buy and sell in UK, I no longer pay any taxes, but obviously not everyone can move easily with countries. The other thing you want to think about is the managing between dividend tax and capital gains tax. Okay, because if you're a high earner, these taxes can increase quite a bit. And typically capital gains is lower than dividend tax. Again, there are a lot of factors and your personal conditions involved. But what I typically do is based on my tax liability. If I, for example, I'm buying a mutual fund, okay, now mutual funds would give you options like, do you want a growth mutual fund or do you want a dividend mutual fund? And the difference is obviously with a dividend mutual fund, they pay you dividend and you pay dividend tax on it. When you say a growth mutual fund, you don't get any money until you actually sell. So I could, for example, hold a mutual fund for 5 years and I will not pay any tax in any of these years. Okay, I pay only tax when I sell, and that's capital gains tax. So you can plan a lot of these things, but of course, it's tough. I mean, you will still have to pay taxes, which I think is fair. I don't mind paying taxes to an extent. Anything else?
Do we have a session where we discuss what kind of forms we need to complete for tax purposes if we want to trade in the US from the UK?
Yeah, so the new generation brokers have made it very simple, wherein when you sign up to their platform, they will make you do a digital signature. So like literally a checkbox, and then a form is submitted in the US. The traditional brokers can be annoying and they will ask you to print out a form, sign and send it back to them. And this has to be done every 1 or 2 years, I'm not sure. So I would say look for a new age broker, avoid like your traditional brokers.
I see. Okay, thank you.
But it's a very simple form. All you have to say is that you're not a resident in the US. And so the tax should not be withheld.
But then does it affect somehow paying taxes in the UK?
No, it does not. I mean, it's only for if you're a US resident and then you're trading in the UK because the prices are better. And then the UK broker is required to withhold taxes.
Just
so don't. Yeah.
Yeah, can I ask a question about this form? Do you receive any confirmation? Because I filed the form, I sent it to the company which doing them forms, and I didn't get any reply. But the form is online, and
yeah,
my
I mean, typically
doesn't allow me to trade in the US, which is a little bit pity. I trade mostly in the UK and Europe.
Yeah, which broker are you using?
It's a Lithuanian one. I'm from Lithuania, so it's
yeah.
InterTrader it calls. So it's
I
mostly
know InterTrader.
yeah.
InterTrader is CFDs. Contract for difference. Yeah, I mean, you'll have to talk to them. I mean, I'm not sure how yeah. But I would say, Irmantas, there are some other platforms which I would, from a EU, might be better off.
Okay, I will check on them. What is better, like, because it's.
Yeah. I mean, a good broker, like a fintech new brokers today, you should be up and running in an account in 5 minutes. If you can't do that in 5 minutes, then it's probably not a good broker.
All right.
Yeah.
Okay, we'll keep in mind. Thank you very much.
Cool. All right. Anything else from anyone? All right, guys. Thanks a lot, and hope to see you on the next session. Thank you.
Thank you. It was very interesting.
Thank you.
Bye.
Thank you.
Bye.
Bye.
Thanks. Bye.